Hello and welcome to BloombergQuint. We've had a monetary policy review, a review of the RBI's policies as well. Two things stand out. Firstly, of course, there was no change in interest rates. No one expected that. On a guidance front, there has been a shift. You moved away from the time-bound guidance that we had given to us last year. Now we are back to, in some ways, BAU, and we moved to a state-based guidance, the economy-based guidance. But what was interesting was the RBI announcing a new tool to control bond market yields. It's called G-SAP. It's essentially a secondary market purchase of 1 lakh crore in government bonds. Much debate about whether this is QE by another name, yield curve control by another name. Joining us to help us sort out all of our dilemmas on these fronts is Kaushik of Deutsche Bank and Arvind Chari of Quantum, our go-to people on all things monetary policy. Thank you both so much for taking the time to speak to us. Arvind, I'm going to start with you and I'm going to go straight into this GSAP, which is going to dominate headlines for a while. So simple, straightforward, how did you read what has been announced?
They want to flatten the yield curve, and they've been trying to do that for some time. They've done ad hoc OMOs, they've done ad hoc Operation Twist. They've given guidance on how much OMO they will do and how much twist that they will conduct. He's done moral suasion by telling bond traders to not be combative, but be competitive, but fall in line with the RBIs and the RBI's trajectory. So the markets were asking for a calendar, right? I mean, if you remember, I think Subbarao had given an OMO calendar in 2012. So they were asking for a calendar saying that the government bond borrowing program is pretty high. Why don't you give us a calendar? The RBI governor actually in one of the speeches actually even said that last year we did 3 trillion of OMOs. Why would we do anything less? It will be 3 trillion or more. But this is different. Yeah, they have now committed very explicitly that at least GSAP, as he called GSAP 1.0, will be 1 trillion in this quarter. Explicit commitment is not discretionary. It's not subject to where market yields are. It's not subject to where the 10-year is. April 15th is when the first auction is, and then maybe they'll announce, maybe every 20-25 days, you will see one of these 25,000 crores totaling to 1 trillion in the quarter. So it's different than an OMO. Because OMO was discretionary, they were announcing a week before and then conducting it. This is explicit in terms of when they will do it, how much will they do. And the markets are going to read it as GSAP 1.0 will be 2.0 in the second quarter, 3.0 in the third quarter, and 4.0 in the fourth quarter. That's what the reading of the market should be and will be, subject to changes. But so that's the difference. There is a very explicit commitment, and you've seen that impact on bond yields. Markets were worrying that the bond yield range, 10-year especially, and because we have so much over focus on the 10-year. The 10-year range will shift from 6.25 to 6.5, that range from 6 to 6.25. Maybe because of the explicit guidance right at the start of the fiscal year borrowing program, maybe you will see the 10-year bond yields remaining contained for some time. But the objective is clear. They want to control the slope of the yield curve, the shape of the yield curve, and make it as flatter as they can.
Okay. I have a bunch of follow-up questions, but Kaushik first, is that pretty much how you read it as well?
So, Ira, first of all, Governor had already kind of indicated that the RBI wants to do INR 3 trillion at least of INR of OMO purchases in FY22. So, market was already expecting that there would be OMO purchases starting from April, just like we had in January, March, to support the market. This is more of a explicit kind of a comfort given to the market that, see, we are there, we'll do at least 1 trillion in quarter one, which was anyway expected. Now, the point is that given the amount of borrowing that we have in FY22, whether market was expecting INR 3 trillion to be completed in April, September itself. And from that standpoint, whether that 1 trillion, if it is like spread across April, December, whether it is lower than market expectations, today is not the day that you'll get to understand, because it has come as a positive surprise because people were not expecting. Also, a couple of things which I want to highlight to you. One is that we have got 1 trillion INR, GSAP announcement for April, June. In January, March, RBI purchased about 1.5 trillion. And the gross issuances was slightly lower in January, March compared to April, June. So sequentially, RBI is kind of buying a little less than what they did in January, March. So it's all about, what RBI has announced with relative to market expectations. Now, as I said, today is a day where market will take this positively. But as we go ahead, one flip side of this pre-commitment is that the surprise element from RBI is also over. So sometimes, the surprise element works in your favor, and RBI can surprise the market by announcing something suddenly or swiftly. Now, if they've already committed, unless something goes out really wrong, they'll not increase it in a big way. So that surprise element is gone. And I'm sure we'll discuss this later. There are certain variables which is not within RBI's control. For example, what happens to US Treasury if it goes to 2.25, if oil prices again visit 70, those will obviously put upside pressure on 10-year bond deals. So those factors obviously will come into play for the bond market later during the course of the year.
No, absolutely. So Arvind, look, I mean, they said that this will run alongside their current liquidity operations, but then Michael Patra also said that this has been built into our liquidity calculations. So it's fair to assume that this will substitute OMOs to some extent, right?
Yes, I for sure. So right now, as the RBI plays it out, G-SAP will be its main market intervention, yield curve management market intervention tool. I don't think you'll be having OMOs and OTs around it. Maybe if like 2-3 auctions fail, or if there is a sudden rise in bond yields, maybe at that time they can choose to do an OT or something like that. But otherwise, you should assume that this is the OMO that we've had before. The G-SAP replaces the OMO. So there'll be, and so they will always keep all the options open, right? Why would the central bank say that I'm not going to do a normal OMO or a normal OT? They will say I'll use everything, but G-SAP is the main tool now.
From a balance sheet perspective, Kaushik, this is no different from an OMO, right? I mean, you'll see various people calling it various different things, yield curve control, QE, etc. But at the end of the day, when Michael Patra said we are committing our balance sheet for the first time, I was a little confused by that. Weren't you committing your balance sheet when you were doing OMOs as well?
I think what he meant was explicit commitment, and there's an implicit commitment when you do OMO and when you give a guidance. This is explicit guidance that I'm going to do this much come what may. And probably, as I was mentioning, that there's an asymmetry that the number could be higher, probably not lower in a particular quarter when they have said 1 trillion, depending on the circumstances. So to that extent, I guess, technically things are similar as far as balance sheet is concerned. But RBI for the first time is probably explicitly saying that we'll give you, 1 trillion bond purchases, and probably it will continue for the next few quarters.
Okay, I'll move on to the macro picture in a bit, but I have a couple of other questions on this. So Arvind, tell me, how does the bond market see this together with, the guidance that's been given, the outlook for inflation, etc. has been given? We did see a drop in yields, but yields have now moved back closer to 610, perhaps reflecting some of what you were saying earlier, that, you react positively, but then you start doing the numbers and you realize that perhaps the support is not incrementally that much more.
So if you look at the three things that happened in today's policy, the first was the stance, right? The outlook. And I think that the RBI was pretty prudent. So where they have changed a time-based stance, as you said, to a state-based stance, where they are dependent on macroeconomic data to be able to remain accommodative. The second was on inflation. I think I think we'll come to this later in detail. They spoke a bit more about inflation than they have seen them do in the last 3, 4, 5 policies. And the third was the VRR, the comment and the saying that they will do long-term VRRs. That was a significant thing. So that has been calibrated by the G-SAP. So this is why I said that although liquidity is ample, they are taking that slow steps towards normalization, and they're trying to prepare the market that there will be a normalization coming. But please don't worry about the long run of the bond curve. I know government borrowing program is very high, but we will do everything to ensure that the 10-year bond yield, remains in a fairly tight range. So I think that's what the market is reading. If you do the math, the way I said it, like, G-SAP 1 to 4, if it's 4 lakh crore, and then there's some benefit from HTM, it may not be enough, but it is a significant support of the government bond borrowing, at least the government bond borrowing program. But unlike last year, which is what they keep on saying, that last year we did 12 lakh crore and 18 lakh crore of net borrowing, including state, and the yields were lowest. But last time the monetary policy was in a trajectory where everybody knew there's no rate hikes, there's only going to be rate cuts and more liquidity. Today, that situation is not there. There is scope and chance of normalization, repo rate hikes happening, and the global scenario is very different, right? As Kaushik said, oil prices and US treasuries are the major driver. And if they keep going up and commodity prices increase as global fiscal supply gets in the market, the trajectory and the conditions are very, very different.
Kaushik, if one puts aside the G-SAP, although I know it is incremental commitment from the central bank, was there a tilt towards hawkishness? I mean, I know it's not hawkish because they are saying we'll stay accommodative, as long as necessary, but perhaps a little less dovish than they were earlier.
No, so very good observation. I mean, if you take the G-SAP part out, what are the things that we got? We got actually an increase in inflation forecast. Although, I believe it's more cosmetic, what they've done, like July, September, they've increased to 5.2 from 5%. And, October, December, they've increased to 4.4 from 4.3%. And they've given a 5.1% forecast for January, March of next year. That is mainly to, I think, make the average 5% for FY22. If you see the average inflation forecast, it's a round figure 5%. So this is more of a cosmetic change. But market will anticipate it as a little bit of uncertainty on the inflation front, and therefore the RBIs increase the forecast. Growth anyway, RBI was conservative, and therefore they didn't need to change the forecast at this stage. 10.5 is a very realistic forecast, which is also Deutsche Bank's forecast for FY22. So there was no need to change that. But if you look at the other things, like for example VRR, that variable reverse repo rate auction, now they're saying that they'll do it for a longer tenor. And, the quantum also we don't know. So maybe over a period of time, if this INR 2 trillion becomes INR 3 trillion or higher, and if market continues to, clear at 355 or higher, the cutoff rate, then beyond a certain point, again, that same argument will come. What is the point of keeping reverse repo at 335 when bulk of the liquidity is clearing at 355 or 360 in due course of time? Now, we don't know how this COVID situation will play out, whether things will be really bad or not incrementally from where we stand. But we still hold on to the belief that by the end of the year, RBI will try to bring the reverse repo rate towards 375 to 20 basis points increase, which will narrow the corridor with the repo rate to 25 basis points. So there are two ways to look at this, a state-based guidance compared to the time-based guidance. The guys who are more dovish will say the state-based guidance means that the MPC has already decided in their mind that we want to hold on for a long period of time. So we don't want to, confine ourselves by giving a, particular time period and get challenged at a particular point of time. The more hawkish interpretation is that RBI or the MPC are still willing to stay on that calibrated exit path without telling you so. And they're waiting for the right moment. If the COVID subsides and you see growth kind of picking up more than what RBI is expecting now, and inflation close to their range, then they will want to not get tied to any kind of time-based guidance and start that exit process. So, no central bank will always want to stay on an accommodative path for a foreseeable future. So there are different ways to look at it depending on your mindset, how you want to look at it. So I guess if you take that G-SAP out, it was more or less, a neutral to slightly on the lesser dovish side, and markets were actually reacting a bit negative before the G-SAP announcement came. And now, obviously, yields have fallen, but we have to see over a period of time how the global developments are playing out, and whether that surprise factor now that is gone, and we know how much supplies are there, whether market will be satisfied with what RBI has announced and whether yields will still want to creep up.
Absolutely. Arvind, the guidance and how you interpret it, I guess the bar, even with this guidance, is very high for a repo rate cut, which I think nobody is factoring in, repo rate hike, which nobody is factoring in this year. But even for a reverse repo rate hike, isn't the bar really high? Because, you can do the small stuff. You can do the variable reverse repo rate, auctions, etc. But a hike in the reverse repo rate will be seen as a de facto rate hike. So isn't the bar for that really high even now?
It is high, but I think we spoke in the last session that I attended with you. So we initially, the way I was seeing it was the bar is on growth. So RBI has to get comfortable on growth being sustainable, and then that sustainability is a key issue, right? What is sustainable GDP growth in India right now? Is it 5? Is it 6? Is it 7? If it's 5, they should be hiking. If it's 6, maybe they have time to wait. If it's 7, then they can wait for a long period of time. getting that aspect, I don't know how they will do it, but getting that different ways of checking output gaps or market realities or near-term macro data indicators. I think that will drive that bar, saying that okay, are we in a position that we can sustain GDP growth at 6.5%? And if it's yes, then we don't need crisis level indicators and measures. The another bar that is there right now, indicator is of course inflation, and I think they are tilting slightly more towards inflation. So as Kaushik was saying, although this was not a hawkish policy, but there are almost 2 paragraphs on inflation and inflation worries and drivers of inflation. So with this forecast of 5%, this is second year, even because of COVID or due to COVID or after COVID, where you're higher than your target and your effective monetary policy rate is 3.35. And as Anand said in the other show, the average deposit rates in India is now below 5.5%. So putting all that into consideration, I think inflation also comes into a picture where last year is only about growth. As long as growth comes back, we will keep monetary policy stable. This year there is the worry of inflation. If inflation goes up, and if if you look at manufactured WPI, which is the indicator of price pressures increasing for manufacturers, how long does it take to pass on to core CPI? Those things will come into picture, and then so the bar is not as high, but the bar is still fairly high for them to hike. They will start with variable reversal course. I think if you remember, in 2006-07 when they started MSS because of excess liquidity of FX reserve sterilization, it started with 1 month, 3 month, and they made it 1 year. I think the VRR also will be 1 month and 3 months. You should expect a 3-month VRR also. And as that tenor increases and they suck out, and depending on how much they suck out in terms of amount, they will start with VRR and even in accommodative policy, you can have a reverse repo rate hike. I don't think there's anything contrary to that. They can remain accommodative, but increase the reverse repo rate hikes. So if inflation gets a bit more challenging, oil prices go up to $70 and above, you will see that reverse repo rate. I don't think it's out of the way.
Kaushik, what's the current base case on when, and I'm saying when we will get towards a reverse repo rate hike first, and a repo rate move is what, well into next financial?
So our current forecast is that October and December, these are the two monetary policy that I would expect 220 basis points reverse repo rate hike, which will bring, as I told you, the reverse repo rate to 375. And bringing it in line with the 25 basis point spread with the repo rate, which was there pre-pandemic. Now, this obviously assumes that the COVID situation that we have kind of doesn't go beyond where we are today, very bad, and across the country, and you see lockdowns. So it kind of reduces beyond what we have seen, and because of the lockdown in Maharashtra, you're okay with 10.5% growth, maybe not 11.5%, 12% as other people have projected. IMF has surprisingly increased the growth forecast to 12.5% when people are talking about downside risks. So the thing is that if growth remains at 10.5%, and the way to look at this is not the YOY growth because there's a base effect element, you'll have to look at the level of growth and the output gap. And my feeling is that by the end of September or December, if the COVID doesn't go out of control, the output gap will keep on closing. And also one thing, remember that when RBI does takes a monetary policy decision, there is a significant amount of lag that they have to take into consideration. So if you're doing a policy today, it is thinking about 3 quarters ahead, how it can impact the real economy. So you not actually wait for the output gap to become positive when you start, reversing the, reverse repo rate or any such, increase. So RBI has to be a little preemptive. So from that standpoint, I think 4th quarter of this calendar year, RBI can think about increasing the reverse repo rate. And, to that point, what Arvind was mentioning, and you asked, suppose RBI is doing 2 trillion worth of VRR now. Now, suppose after 3-4 months, RBI starts doing 4 trillion or 5 trillion, and the entire amount of liquidity is clearing at mostly at 355 or 360. Then 335 reverse repo rate becomes immaterial, right? I mean, you can keep it, but it doesn't mean anything. So you can, because market is already adjusting higher, so you might as well increase it, whether it's a signal or not. So that can play catch up. And on the repo rate, we think there could be a 50 basis points repo rate hike in the first half of 2022. Either it could be February, June or April, June, depending on this COVID complication that has come through. But if everything goes well, if you get a 10.5% growth with next year, probably around 6%, I think slowly RBI should think about normalizing, because your real interest rate is well into negative territory. And it's today, this financial year, the situation is not like last financial year, where growth was -8%. So you have to give some weight to inflation when you're inflation targeting central bank. And when RBI themselves are projecting inflation 100 basis points higher than their target rate. So when the output gap closes, then RBI cannot, not think about normalizing, at least in baby steps, and preparing the market rather than having to go in a very fast manner if things go out of control on the other side.
Okay, understood. Just as the last couple of questions, I'm going to circle back to the GSAP. So Arvind, if one looks at this in a bigger picture scenario, right? We have 12 lakh crore in borrowings. We have the glide path for the fiscal deficit, which is not as quick of a glide down as one would have earlier anticipated. So it's fair to assume that we're going to remain in an environment of relatively high government borrowings. So the supply is going to be fairly strong. On the demand side, unless that long-awaited foreign bond listing, foreign bond index listing happens, demand is what it is right now. Do you think the central bank has found itself now in a fairly extended period of yield curve control, QE, take your pick of what you want to call it?
Yeah, quite clearly. And if you look at the expectation of the market also, it'll keep on increasing, right? And it has increased. No one expected LTR or LROs came. No one expected OTs came. And that expectation has gone up and up. And so this GSAP, the market will now want it every quarter, for sure. They still seem very obsessed about the 10-year. And that's where the majority of the interventions by the RBI is coming. And they are very optically trying to ensure that the 10-year yield doesn't go up. The 5-year yield has actually had moved up till about 2 weeks back, almost 70-80 basis points from its low. And that's the more sensitive curve to the economy. The 10-year is irrelevant, but the 3-year, 5-year, 7-year curve is more sensitive to the economy, corporate bond borrowing, and then entire yield curve. So they are in. I mean, the GSAP, as I said, that's the difference between an OMO and a quantitative easing, right? When the Fed started quantitative easing, it was a direct committed amount of money that they're going to buy every month, and they used to give out a schedule. This is very similar. This is very Fed-like. There's no discretion in an OMO that the OMO has. GSAP is there, is committed, and once it is mentioned, they'll have to go through it. So yeah, they might not call it yield curve control, but it is very strong yield curve management, and they'll have to do it for some time, as you said. And the fiscal deficit at 4.5% for FY26 is actually very, very significant. If you look at the average fiscal deficit from now till FY26, it's going to be above 5.5%. So the amount of bond supply and fiscal deficit and expenditure that's going to come about is significant, and you will need that bond index inclusion sooner than later for demand supply to match.
Kaushik, last word to you. So here in India, we don't obsess or speak as much about, the RBI's balance sheet as a percentage of GDP, perhaps because, for a long time it has been fairly stable. But we ended FY21 at very well above, that 25% range. I think we end close to about 30-odd%. Implications, is that a factor at all for the RBI as they try and, sort of weigh the extent of bond purchases from here on? Or is it, right now, the priority is very different, which is growth and sustainable growth?
See, Ira, first of all, this RBI is completely different from what RBI was a few years back. And to their credit, I think from 2019, Governor Das started cutting rates on a preemptive basis after the IL&FS crisis, and also turning liquidity into surplus. And that allowed a lot of transmission to take place. That was a very good decision to have taken. And then, they have gone into soft yield curve control. Now, the point is, if you think of it, RBI buys about 15%, the outstanding bond holding of, the local currency bond market. RBI is 15%. The banking system is 38 to 40%. It has come down a bit. And then you have LIC and insurance companies being at 25%. FIs are just at 2%, and, others are not that significant. So the point is, if you expect the banks to be lending to support growth, and you have a certain NDTL increase every year, 10% or whatever, then, and if you think that the yields are bottomed, why will banks want to buy more bonds beyond their NDTL management? So, and if the banks are out not to buy more than what they require, and they are 38% of the market, then you are left only with RBI to kind of decide whether they want to support the market or not. If RBI is not there, yields will go up. It's as simple as that. And the bond index inclusion, even if they announce by the end of this year, this takes time. If you look at the China experience, it takes 1 or 2 years for serious money to come in. So till that time, you'd be left on your own, and without RBI support, there is nothing you can expect as far as yields are concerned. Now, think of it in two different ways on the bond market side, the challenges. If the COVID challenges increase, along with that, expectations of support from the fiscal side will also increase, and the market borrowing expectations will also increase. So that is another pressure on the bond market if that were to happen. And if the COVID were to subside, and you think that RBI will be on a calibrated exit path, then that also would lead to market expecting yields to go up, because RBI would move by hiking the reverse repo rate and then repo rate at some point of stage. So bond market at whichever way you look at it will be under pressure. And what is happening globally from the US side and the oil factor, always there would be uncertainty related to that. So at best, what RBI can do is kind of smoothen out the increase in the bond yields that are expected. So to decide at what level they can be within a particular period of time, and that is what RBI is doing. And they should not try to attempt to get a particular level on the bond yield of a particular tenor, because that kind of creates a lot of confusion and distortion. And then suddenly, if the output gap closes and miraculously, suppose the COVID problem goes out in India and you have more vaccination happening, and then suddenly RBI will have to withdraw faster than what market was expecting, that can lead to a bigger increase in yields. So I think RBI has taken a kind of good step. You have to look at the balance sheet in the perspective of what has happened, the kind of shock that we have got from the COVID-19. Without this, we would have to have a bigger growth sacrifice. So for the time being, this is okay. Now, as RBI had been preemptive in cutting rates, when things are falling back to normalcy, we would expect RBI to be proactive on that other side as well, to ensure that you don't create a problem on the inflation on a structural basis, and then RBI would have to hike rates faster. So those kind of problems should be avoided.
Understood. I'll leave it at that. Thank you both so much. Appreciate you taking the time on a busy day to help us understand some of this better. Thanks, Kaushik. Thanks, Arvind. And thanks to all of our viewers for watching BloombergQuint.